Hello everybody, welcome to our first video for the practice journal entries for accounting, financial accounting. And this first video we're going to cover just some very basic entries just to give you a feeling of what the journal entry should look like. Now before we get started into some actual journal entries, I just wanted to remind you of some of the rules for journal entries. And these have been covered in previous videos as well, but I'm going to be covering them at the beginning of each of these practice videos. So the first rule would be that debits are always found on the left side of a journal entry, and they always come first. No matter how many debits you have for that particular journal entry, they're always going to come first. Credits will always be indented to the right side, and again, all of the credits for a journal entry come after the debits. Now the second rule here is that there can be a different quantity of debit versus credit entries. So in other words, you could have 2 debits and 1 credit for a particular journal entry, or 1 debit and 3 credits. The quantity itself isn't a concern. The dollar amount is what's the concern. The total dollars of all the debits must equal the total dollars of all the credits. So that's the rule there. Now the other thing we need to remember would be the normal balances of each account type. Now the reason we need this is that if we want to increase a particular account, we have to use its normal balance entry. And if we want to decrease it, we use the exact opposite of the normal balance. Debits and credits are opposites. Now, there are a few different ways to learn this, but the way I always teach is with the mnemonic device. That's one of the ways I show. So DED is one of the mnemonic devices for your debit accounts. And then CLRC, whether you call that clerk or Clark, whatever works best for you, that would be a mnemonic for the credit accounts. So the DED mnemonic shows that the debit accounts include expenses, assets, and dividends. Those are our normal debit balance accounts. The credit balance accounts include liabilities, revenues, and common stock. So you know that to increase those 3 accounts, you use a credit balance. Now we'll see a little tiny reminder of those normal balances in each of the journal entries. So some steps for the journal entries. Step 1, we have to identify what accounts are even involved and what amounts are involved. Identify whether each account will be increased or decreased. And then step 3, which is where it starts to get a little bit tricky, you have to use those normal balance rules to identify how do we go about increasing or decreasing each specific account, the normal balances. And then the other thing, kind of as a last check, ensure that the debits and credits for each journal entry actually balance out. So let's take a look at this first transaction we have. Again, we are starting with the very basic transactions just to give you practice in working these, because what I'll mention here is that journal entries are the foundation to all of accounting. Really the first at least 4 or more of your accounting courses are going to rely on your ability to properly record a journal entry. So that's why we're doing this practice. We have quite a few videos going through a set number of transactions that are progressively more difficult. So transaction 1. The company borrowed $25,000 cash from the bank to start the business. So as far as the amounts go, it's pretty straightforward. It's just $25,000. Every account in this particular transaction is going to be impacted by $25,000. From a company's perspective, they have $25,000 more in cash. But the thing is, they also owe money to the bank. So they have some sort of debt. So that's what we need to consider here. Now the way this would show up, first of all, in the accounting equation. We're going to do this analysis first and then we'll move down to the journal entry. Remember, assets must equal liabilities plus equity, and equity has these few components: revenues minus expenses, and then we subtract out dividends. Capital is added into all of this to give us equity. So the company has more cash, so assets, cash is an asset, that's increasing, but they also owe money, that's a liability. So there's a $25,000 increase to, we'll call it notes payable. That's the general account being used. And the thing I want to mention here is that when you're doing these, you're going to have to know what account name that company gives it. A lot of times if you're talking about just textbook problems, they'll give you a list to choose from. Um, Notes payable would be the pretty standard one here. Loan payable, I suppose they could call it. But some of these we'll talk more about because they're not quite so straightforward. So our assets increased by 25,000, our liabilities increased by 25,000. We're still in balance across the board. That's your first test. Now we go down to the journal entry, recording the actual journal entry, and we want to know, how do we increase this asset, this cash asset? If you go down to the normal balance rules, remember that the asset was under the debit category, the dead mnemonic. So to increase an asset, you debit it. So we're debiting cash for $25,000. Notes payable we also want to increase. So notice both of these things we're going to increase. Notes payable, which is a liability, over under the credit category, the liabilities are credit accounts. So you increase them with a credit. So we're crediting notes payable for $25,000. Our accounts are in balance. We have a debit and a credit to $25,000. So we're good to go. Now, by the way, you would normally have a date here. I've just put in a placeholder date for all these transactions. It doesn't give us any specifics. We're not focusing on that. We're just trying to make sure you understand what to debit, what to credit. The other thing you'll often see would be a description down beneath the journal entry. It would just be a one-sentence summary of what the transaction said. Again, we're not going to focus too much on that. We're really just focused on how to properly record the journal entry with the debits and credits. So that's transaction number 1. Transaction number 2. The owner invested $175,000 in cash to help fund the business. This was in exchange for common stock of the company. Now, at this point, what I want to also mention is, as you're viewing this video, it might be helpful to just press pause and think this through. Maybe work it out on some scratch paper or Excel to see if you come up with the same answer that we're going to talk about in just a bit. So feel free to do that for each of these transactions. Press pause and then restart it when you're ready to look at it. That's probably a good way to practice. So with this one, the owner invested $175,000 in cash. Again, the company has more cash. That's the key thing. Now, this was in exchange for common stock of the company. So apparently this is some sort of corporation, and the owner is a stockholder. Now, that increases both the cash for the company and the recording of common stock. Even though it's the owner's stock now, the company themselves has to record it on their side as well. So we're going to see this. The assets have increased by $175,000, and what's called capital, or common stock in this case, has also increased by $175,000. That's the equity component. The owner has equity in the company. This equity account is just recording how much the owner has. And then $175,000 assets, which in this case was cash. So we want to increase cash for $175,000. We want to increase capital for $175,000. Assets are increased by a debit. Capital, or common stock, is increased by a credit. So debit to cash, credit to common stock, both for $175,000, and we are still in balance. Transaction number 3. The company paid $45,000 to acquire a piece of land. So now we're going to start to see our first situation here. The company has paid cash. They didn't specify cash, but they didn't specify anything else. So when you say paid, generally that's cash. They're paying cash. They now have a new asset, land. So what we're going to see here for the first time are two transactions that offset each other. They're both under the asset side. One is a subtraction to assets for $45,000 for cash. The other is an addition for $45,000 to land. So there are no liabilities, equity accounts impacted because the asset is net zero. Therefore, the rest of it can be zero as well. Now we're increasing land, which is an asset. We increase that with a debit. We're decreasing cash, which is also an asset. To decrease an asset, you use the opposite of its normal balance. Therefore, we need to credit that account. That's what's going on here. Transaction number 4. The company has purchased $20,000 worth of equipment to begin their operations. So $20,000, again, when they say they purchased, there's no specific reference to cash, but there's no other. Sometimes you'll see verbiage like on account or on credit, where that means they're going to pay later. If you don't see anything like that, the assumption is they must be paying with cash. So they're spending $20,000 of cash, and they now have equipment. So this is the same basic situation as before. We have a subtraction to cash for $20,000, an addition to another asset, equipment for $20,000. Therefore, the net effect is $0 for total assets, and nothing else needs to be reported. The entry here, similar to the last one, we're trying to increase the equipment asset, so we have to debit it. That's its normal balance. We're decreasing the cash asset, so we have to credit it, use the opposite of its normal balance. And that would be the journal entry in this situation. Now they purchased $10,000 worth of supplies on account. Here are the keywords I was talking about a bit ago. They're still purchasing them, but it's on account, which another phrase for this is on credit. This means that they're not paying cash right now. They're setting up an account, and they will pay it off later. So in this situation, we have one asset that's increasing, the supplies asset, and then a liability, accounts payable, that's increasing as well. Now again, this is another term. We talked about notes payable earlier. Accounts payables generally are a little bit less formal. They're when you're just dealing with a vendor that you constantly deal with, frequently deal with. You set up an account and then you pay them off usually 30 to 60 days. But again, you'd want to know for sure what account name that company uses, what account name that textbook problem is looking for. So you increase supplies for $10,000, increase liabilities, accounts payable for $10,000. Supplies are an asset. Assets increase with a debit. Accounts payables are a liability. We want to increase that. That's a liability. We increase it with a credit. So we're debiting supplies, crediting accounts payables for $10,000. Now, transaction number 6. The company hired Adam Smith, who will begin work next week. His salary will be $40,000 for the year. So they hired him. He's going to begin next week, but he has not worked at all yet. He's not done anything at all. And really, this is somewhat of a trick question. No transaction has taken place. So there's no transaction needed, and therefore no journal entry needed. The next one is this company performed services valued at $700 for a customer, receiving cash immediately. So the key thing here is they get cash immediately. They perform services. That's how this company earns revenue. So they're recording both the revenue and the cash receipt for $700. So $700 cash asset needs to increase, and a revenue, which is under equity, a revenue needs to increase for $700 as well. Assets are increased with a debit. Revenues are increased with a credit, though. So we're debiting cash to increase that. We're crediting revenues to increase that, and we are still in balance. Transaction number 8, a little bit different here. We perform services valued at $1,200 for a customer on account. So here's that magic phrase, on account. That means we did not have a cash transaction right away. Instead, it's going to be related to an account, and we'll talk about which one in just a bit. But we did perform services, so we earned revenue. The amount for both would have to be $1,200. The account name in this situation is called accounts receivable. It's an asset that reflects the fact that we are expecting to receive cash in the very near future. The amount was $1,200. We're increasing it. Revenues are a component of equity. They increase equity. So we have $1,200 of revenue as well. Assets, like accounts receivables, are increased with debits, and we do want to increase it here. Revenues are increased with credits, and we want to increase that. So we're debiting the accounts receivable, crediting revenue for $1,200. And we're good to go. We're in balance. This account entry increased both of these transactions. Increased both of these accounts. Now if we get to transaction number 9. At the end of the month, we received a utility bill for $80 for that month's utilities, and the company paid it immediately. So that's a key phrase. We're paying it immediately. We're getting cash. We're paying cash right away in this situation. The other thing to take out of this statement is that we received a utility bill for $80 for that month's utilities, and the company paid it immediately. So that month's utilities. It's not for last month or anything like that. Later on in later videos, we're going to talk about when we receive a bill for a later month's utilities, if we prepay it or if we pay it related to last month. We talk about how to record those adjusting entries. But for now, this is just a single month's bill. Now, in this case, we are paying $80. So we have a subtraction to cash, an asset, $80. And now this is the first time we've seen the expense account used. So I want to stress this. It's an important concept. We know that on the accounting equation, whatever we do to the assets has to be offset by either a liability or an equity type entry. So if we are just decreasing a cash asset by $80, something on this right-hand side of the equation has to be decreasing by $80 as well. Now, it's going to be either liabilities or equity. Remember, the basic accounting equation, assets equals liabilities plus equity. There happen to be these 4 components of equity. 2 of them, however, when we increase them, we decrease equity. If we increase expenses or we increase dividends, that decreases equity. So what I'm telling you is that for this expense, for this particular account that we're going to talk about, we're increasing the expense account, which decreases equity. So if you just glance at it at first, it appears that we're out of balance. A negative 80 and a positive 80, that seems out of balance. But remember that this positive 80 to expense automatically decreases equity. Now, depending on the problem you're looking at and how your textbook is set up, how the assignment submission portal is set up, they may expect the expense to be a negative, reflecting the fact that it has a negative impact on equity. But in reality, for just the expense account, we're increasing it. So just pay close attention to that. And that'll help you if we remember we are increasing the expense account. That'll help you remember what we need to do down in the journal entry. So this is at the end of the month, so I changed the date to 10/31. Now let's say if we take a look at the cash, we'll just go left to right. The cash is decreasing. Cash assets are debit accounts. So to decrease them, we have to use a credit. So that's why we have the credit to cash here. The expense account, that's the dead mnemonic. That's an expense, it's a debit account. We increase that account with a debit. So we have a debit and a credit for $80 were still in balance. Finally, transaction number 10, we received $200 from a customer on account. So in this situation, it's $200, and I want to pay close attention to this. We received it from them on account, which means they had an account previously set up with us. We provided a service or sold them something. We set the account up. Now we're receiving it. So that's the key thing to get here. What this means is we are receiving $200 in cash, but the accounts receivable balance that we had previously set up is now decreasing by $200. They're both assets, so we increase the cash with a debit. We decrease the accounts receivable with the opposite, the credit. Debit cash, credit accounts receivable, $200 here. So the idea here, this takes us through video 1. Practice makes perfect for these accounting entries, for these journal entries. It really just takes a lot of practice understanding what do you debit, what do you credit, what do you need to do with that account to begin with, what account names are you going to use. So we have around 20 of these videos that we'll be going through. And again, the sole purpose is to cover the journal entries to give you practice for that. The examples are going to become progressively more complicated as we go through the series. This first one just talked about some very basic entries. Every account had one debit and one credit. No real tricks to it. But we're going to talk more about some real situations you might see in whether it be textbook exercises or in real life. So hopefully this helps to clarify what you're going to see for some of these. I look forward to seeing you in the next video in this series. Thank you.